your money may not be safe at the bank, because not all banks are created equal. My name is Darius.
And I'm Carmen. By the end of this video, we are going to give you a thorough walkthrough of what banking is, how the systems work, and how you are affected. So pull up a chair. Let's go ahead and dive into it right now. So I want you to make sure that you understand what fractional reserved banking is. And what fractional reserve banking is the banks only need to keep a fraction of your deposits on hand. That's why we've seen banks collapsed historically and also recently.
After the stunning collapse of two U.S. banks, Signature Bank and Silicon Valley Bank.
So let's talk through this, and I'm just going to give you an example. Let's say that you put $100,000 in the bank. You deposit that into the bank from your income. The banks are only required, for this example, to hold 5% of your deposits on hand. That means they can lend out $95,000 of your income to other people who need lending opportunities, right? So what happens is the banks assume that not all depositors, such as yourself and everyone else who deposits money in the bank, is going to need their funds every day, all day, right? So they keep your money circulating so that they can generate revenue for themselves because they're a business, right? And also being able to pay you interest on the accounts that you sign up for them. Mm-hmm. So the thing that you need to really understand with banks is, one, what are you using banks for to store your capital? And then two, do you use them for lending, such as your mortgage, your car, personal loans, credit cards, things like that? Understand the products and services that you use at the bank, because all they're doing is just recycling the deposits that are put into the bank every single day.
All right. So just to hone in on how a traditional bank makes money, Carmen said, traditional banks make money by interest payments from their risk-based lending. Mm-hmm. Like she said, your car, your mortgage and credit cards, whatever you use the banks for. Mm-hmm. Now, we also help the system by also paying cash, not just credit. Because when we think about it, if we store our money in the bank and we go to make a purchase, our account goes to zero and we have to work our way back to where we are so we can make another purchase. So we're still storing our money in the bank to feed this system.
Yes.
And again, the banks don't expect everybody to come and get their money at the same time. Now, what we saw happen recently was with Silicon Valley Bank and Signature Bank. They recently failed because there was a run on the bank and they didn't have all the funds. Now, we also on this channel talk about creating your own banking system using whole life insurance, dividend paying whole life insurance.
Mm-hmm. Now, wait, before you go into that, I want to make sure, again, that we all understand what's happening. When Darius said a run on the bank, that means that all of the depositors, or many depositors, came and said, hey, I need my cash. And they cleared out the drawers, the cash drawers, right? Because sometimes what happens is people get tips like, hey, the bank is low on deposits, or hey, I heard that the bank isn't doing so well, or hey, I heard the bank that is investing in risky investments. And now people get scared and start saying, oh, wait, I don't want to be a part of that. I want my cash. And the next thing you know, when you go get it, your mom, everybody goes and gets their cash. That affects the bank and what they have on hand. Mm-hmm. So that's where when you see banks collapse because of run on the banks, meaning that people are coming and getting their deposits.
Now, when it comes to FDIC, also the insurance that banks have, they only insure up to $250,000. Now, the problem or the situation that happens with some over 65,000 depositors into the Silicon Valley Bank is that they had over $250,000 in their account that isn't going to be insured by the FDIC. So that becomes a problem. Mm-hmm. And that is potentially a problem for a lot of people, because they have most of their money sitting in the bank, or they think it's sitting in the bank, but it's not. It's lent out to other people because the banks need to make money from interest.
Yeah. And also, too, the trickle effect. A lot of times people feel cozy when they go, oh, well, I'll be insured up to $250,000. But you also have to understand that system because that system actually, from what we've seen, has only has 2% of all of our deposits on hand, meaning if every single American citizen went and got all of their money back, they only have 2% of the funds available to pay you back. So the other thing with this process is we need to make sure that you all are empowered to understand how these systems work and how you need to make sure you cover your assets in more ways than one to ensure that you don't fall prey to these systems when they collapse. So meaning you, one, at least don't have more than $250,000 in the bank. And then also understanding what are your options as far as what other products and services can you use when it comes to accessing capital and utilizing cash? So I know that was something that you were going to jump into with whole life insurance.
So with the FDIC, it is insurance. They're insuring the money. So if we take a step further into insurance, we talk about a product called dividend paying whole life insurance to take over the banking functions in our lives, where we use the system the exact same way we would a traditional bank. We just aren't financing our lifestyle needs through a bank, and we're paying ourselves the interest versus paying it to the bank. Now, there's two fundamental difference in the way banks are regulated and insurance companies are regulated. Banks are regulated on a federal level. Hence, they have the FDIC insurance and the Federal Reserve Banking and whatever rules that are associated with having a federally run business. That's a traditional bank. Insurance companies, on the other hand, dividend paying whole life insurance companies, they're regulated mutual. They're regulated on a state level. Now, the difference is you can't do fractional banking or any cousin or derivative of that with insurance, because insurance, they have to ensure that every dollar is accounted for is based on Austrian economics, which $1 protects $1.
Yeah, and you also have to understand too, with insurance companies, they are fined if they are not able to pay death claims. So that's why it's very important for you to understand as a policyholder, if you obtain a whole life insurance policy, that you understand the guarantees and what is available to you, because again, this is something that the insurance companies are obligated to pay to you. And if you want to know more of that information, definitely click on the link below. We would love to serve you at Wealth Nation.
Right. So there's one that has a guarantee of all your funds and one that only has insurance up to $250,000. So that means there's no limit on how much of your hard-earned cash you can have available in your dividend-paying whole life insurance, and there's no limit on how much money you can put into your dividend-paying whole life insurance policy either. Now, with that as our foundation, how we use it is going to be the exact same way. So instead of financing our credit card and paying 20% interest to a traditional bank, what we can do is, once that money is available as far as cash value in our policy, we borrow it and take care of our financial needs and pay ourselves back the interest we would have paid to a traditional bank. That way, what we can do is we can accumulate interest in our own system. The exact same way a traditional bank is accumulating interest by lending out 95 or 90% of their depositors' money that you've credited to them. They can lend out those funds to somebody else and earn interest on it.
Yeah, and again, this all just goes back to knowledge and understanding what I said before, what is available to you. Because before, Darius and I understood this concept of utilizing whole life insurance policies for our needs, besides life insurance, besides just cashing out the death benefit. I want to make sure you guys hear that, is because we only knew that we could utilize banks. Right? That was the only option that we knew. And so for you, a lot of people are storing their savings in other products or storing their income in other products and services that the financial market offers you. But again, it's just making sure that you understand what is available to you. That's why it's important for us to make sure that we share this information, empower you all to go do your education, find out your research. And if you do want something like what we're talking about, we would love to serve you at the Wealth Nation by clicking the link below. And also remember that we are not going to ask you to contact us. So if you see any comments below where we're saying to contact us at a phone number, we will never ask you to do that. That is spam. The only way that you can get in contact with us is if you contact us in the description below.
And one thing I want to mention is what makes a bank is the fact that they can store your cash and they can provide credit to you. Now, when we talk about credit, what that means is you don't have the funds available to go and make a purchase of your brand new washer and dryer. So what you do is you go to the bank and you finance that with your credit card. Now you have a negative couple grand of whatever it costs for your washer and dryer, and you have to work your way back up to zero. Now, it also works the same way. Banking works the same way with cash, because you save up a couple grand to make a purchase of your washer and dryer, and then you are at zero and you have to work your way back up to make a new purchase. So at the end of the day, both people end up at zero, and they have to put their money back into the system to build up or build up their cash again, either to zero or to where they are. Now, we can do this exact same scenario with our life insurance policies. The only difference is when we borrow money from our life insurance policies, we're using our policy as collateral, and we're borrowing money from the insurance company. So our money continues to grow at a guaranteed rate.
Yes,
absolutely. That doesn't happen when you use a traditional bank, because one, if you do credit, you're paying them interest. And two, when you use cash, you don't have any ability to earn interest because your money has been withdrawn.
Yeah.
So what we're doing when we talk about using a dividend paying whole life insurance policy is we're taking the best of both worlds, where we can continue to earn money because we use our own money as collateral to get money from the insurance company. Now, it's important in this very next step that you pay yourself interest. Why? Because you would have to pay yourself interest in any traditional banking situation. This is how we can continue to generate wealth for ourselves and not be a part of whatever happens on this federal level of run on a bank or risky investments. Because again, not all banks are created equal. There are businesses ran by individuals, financed by you.
Backed by you.
Backed by you.
Exactly.
You are a creditor to the bank.
Now, one thing I don't know if you all picked up what Darius was talking about is, again, we are only talking about banking, which is the entry level step to doing anything that you want to do with your money. We have not yet talked about how you are investing your funds. We are only talking about what are you doing with your income. So that's why a lot of times people confuse what we do with banking and investing, and we are only ever just talking about banking, which is what are you doing with your funds before you get to the point where you start making money or making interest from those funds. So again, empower yourself, understand what's out there for you to just have a place for your income so that you can understand exactly what you can do to then invest and make more money.
Right. It's important for you to have a solid foundation. And if you don't have a solid foundation, what can you really build on sand? Or period. What can you build on something that doesn't have a solid foundation? What can you build on sand?
Exactly. I don't know. Let us know in the comments if you figured that out.
Right.
But otherwise, go ahead.
Right, because you don't want the risk at your foundation. You want the risk at what you decide to risk your money on. And a whole life insurance policy is not an investment. It's not a risk. It's not an investment. At the end of the day, first and foremost, is for death benefit. It just happens to build something that's called a cash value, which we use so that we can finance the things we need in life and pay the insurance company back.
Yeah, so to bring this all full circle, when we talk about banking and fractional reserve banking, is remember that the banks only have to keep a fraction of your deposits on hand. And what that means to you is that your funds are being lent out and the banks are making money from your deposits, which is totally fine because they're a business. That's what they're supposed to do. So we're not saying that the banks are bad guys by any means. They're doing what they need to do, but you need to understand the repercussions of what that entails and how it is affecting you. And that's why many people who were affected with these banks being collapsed historically and recently is because they had more than $250,000 in the bank, so that they lost that insurance, right? And then the other piece of it is just not being aware of what the banks are investing in and how they're moving their money to make sure that they can keep their doors open.
Right. And another thing the banks are doing for us is the things that we don't want to take responsibility for, which is managing our own money. We go to the bank and ask them permission to borrow money because we don't manage ours correctly. And one of the big differences between getting money from a bank and getting money from an insurance company is when you get money from the bank, they tell you when you're going to pay, how much you're going to pay, and when you'll be paid off. And they'll tell you every single month a couple times before your payment is due. When you borrow money from the insurance company, you have to take on all those responsibilities for yourself. They're not going to tell you how much money is due. You're not even going to have a due date. The only thing they're going to give you is your check that you asked for, and you have to have good money management skills prior to, so that you can make this system work for you. Because now you have to wear all the hats that we have delegated to a traditional bank. You no longer have that when you're creating your own.
Exactly. That's a really good point, which goes back to empowerment in a different way, because now you have to take charge and make sure that you're paying your loans back to keep your system running.
That's how you wreck your system too.
Absolutely. Now, Wealth Nation, again, if you want to know more information, click on the link below, but go ahead and check out our next video so you can continue understanding how to build your own banking system.
Remember to own your own lifestyle,
or someone else will.